Hello everyone. Today we're going to be talking about supply and demand and how you could plot the supply and demand curves in order to determine the equilibrium price and quantities. When we talk about supply and demand models, we're mostly talking about competitive markets. And those are markets that have many buyers and sellers. We're talking thousands, hundreds of thousands, millions even. They have the same good or service. So this kind of model applies most for commodity-like products, but less for specialized, unique sort of products or services. And the third most important part is that no individual's action has a noticeable effect on the price, and that relates to market share. In other words, a company that has a too high market share, say for example Coca-Cola in the beverage industry, any decision that such a company does in terms of price or quantity will affect the overall market. So in that sense, the market is less competitive. Okay, so think about this model as an ideal case of a competitive market, but once you start to apply it into a certain situation, take it with a grain of salt and consider that there are some markets less competitive than others. Okay, so the two most important pillars of this model are the price and the quantity. So we will plot the price on the vertical axis, we can denote it as P, and the quantity Q on the horizontal axis. Okay, you could have similar models where you're talking about labor wages. So for example, the wage is the vertical axis and the horizontal axis is the employment level and so forth. So there are comparable models as well in this case. The first curve we will look at is the demand curve. Here we denote it as D. The demand curve is a downward sloping curve, and what it shows is that, what it tells us is that as the price goes lower, the demand quantity increases. So this takes the perspective of the buyers. So any consumer or any buyer who wishes to buy any item is more likely to buy as the price goes lower. Now when we look at this model, we're looking at thousands of people, hundreds of thousands and so forth. So as a total, if the price goes down, as you may know, the demanded quantity goes higher. But likewise, as the price goes up, the demanded quantity goes lower. Okay. The other curve is the supply curve, and it's based on the perspective of the supplier or the seller, the manufacturer. Okay. And what this one says is, as the price goes higher, the manufacturers are more willing to sell. They want to sell more. Even if it goes very high, there will be new manufacturers who enter the market to sell this kind of good or service. Okay, so think about it when you are trading or you're going to a shop. You want to buy, as the buyer, you want to buy at the lowest possible price, while the seller wants to sell at the highest possible price. And oftentimes the trade happens at a compromise between what you would like and what he would like. Okay, this is exactly the case when we set it into the model here. So when we plot both, we will see that both the demand curve and the supply curve will intersect, and this point of intersection is called the equilibrium. Okay, here we denote it as E, and this equilibrium has a value for quantity and a value for price, so Q, E and PE. That means for an efficient market or a competitive market, the price and the quantity of a certain good is determined by the supply and demand. Okay, so in the next videos we will look at what changes can you have on the demand curve or the supply curve. Any change that happens will affect the eventual equilibrium price and quantity. So anytime a price or average price changes for a certain good, it is due to a change in the supply and demand. If you have any questions, please write them in the comment section below. I'll make sure to answer as soon as possible. Also, make sure to like this video and click the subscribe button for more interesting finance and management lessons. Thanks for watching.